Okay, so hi everyone, this is Finance Meets Real Estate. We have Gino Barbaro here today. It's a real pleasure to have him. He's the founder of Jake and Gino LLC, and he will discuss syndication versus partnering. His initial experiences with, not doing syndication, with partnering on deals, doing his own deals, why he switched to syndication, etc. So he's an investor, business owner, best-selling author, and entrepreneur. He has grown his real estate portfolio to over 100 million in assets under management. He also has a multifamily real estate education company called Jake and Gino that offers coaching and training in real estate upon their framework: buy right, manage right, and finance right. He resides in St. Augustine, Florida, with his wife, Julian, and their 6 children. And so if you guys have any questions, obviously we're going to do a more open format today, so feel free to speak up at any time. And I'm going to relate some questions myself as well. It's a real pleasure to have Gino here today. I know he's feeling a little bit under the weather, but he's so is gracious to share his time with us. So that is great. And yeah, with that, I'm going to pass it on to you, Gino.
Stefan, thank you for having me on. I got sick this past weekend. I said, I'm going to get over it, but not really. Feeling a little bit under the weather. But, when you're an entrepreneur, it's one of those things where it's just another one of those. I've been in business since 1994. That's when I opened my restaurant in New York. Had it for about 20 years. We sold it in 2019, but I left in 2016. The restaurant to go into real estate full time. And Jake and I, we started back in 2013. Well, we bought our first deal. And like you said, Stefan, we didn't know syndication back then in 2013. It wasn't prevalent like it is now. There was no money back then like there is now. If everyone goes back to 2010, 2011, the economy sucked. Rents were $300. There was no money. There was deals on LoopNet, but there was no cash. So we started out buying deals. That's what we were doing, just buying deals ourselves. 18 months, we bought our first deal with a 25-unit property. 3 months later, we called the momentum. 3 months later, we got our second deal. It was a 36-unit property. It was with partners. And then our third deal, 136 units, 6 months later. Our first 1,000 units, we did no syndication. We were able to refi and roll. We were able to refinance all the proceeds out, roll into the next deal. We did about $15 million in refi and roll to date. First 1,000 units, like I said, was not syndicated. And I look back at that now, Stefan, and I say, should I have done syndication sooner? Because now we have 3 deals that are syndicated. We've sold one, and we're in the process of selling another. And for me, I think the key takeaway that I want everyone to take away from this, call tonight is really to look within yourself. If there's one takeaway tonight, what is it that you want to accomplish in real estate? For me, I had a transactional business for 20 years. I was selling pizzas. Someone comes in, gives me $20. The end of the week, I make X. I start the shit all over again the next week, and then the next week. And I said, I don't want to get into real estate to flip. And to me, in the beginning, syndication felt that way. I wanted to own a few deals. I wanted to get some equity and have a little bit of cash flow. And that first deal, believe it or not, that 25-unit deal, we still have the majority of our portfolio. We bought it for a great price. We refinanced all the proceeds out. It's a 25-unit little crappy property. There's cottages, there's duplexes. It cash flows $8,000 every month. And I have a partner with my brother and Jake. So I'm paying my kids' college with that one deal. Now, most people would say, hey, you have a mortgage of $500,000. The property's worth $2 million. Why don't you sell it? Maybe I would sell it. But my next question is, where am I going to put that money? Where is that money going to work today? Where am I going to find a better deal? I already have cost segregation on the deal. It's an easy deal to manage. And every month it's printing money. And one thing I've learned in real estate, the people who truly get wealthy in real estate are the ones that buy and they hold for the long term. Now, the problem with that is when you first start out, we buy anything we can. And one thing I learned in the last 5 or 6 years is something called the 3 pillars of real estate. When I started buying deals, you could buy C and B properties at 7, 8 caps. So it was okay to buy those properties because you were buying at a good price point and you were able to refi and roll. Now, at this price point, at this part of the market cycle, it's a little bit more difficult to do that. So my big takeaway, Stefan, for this call for everybody, just look within. Syndication is an amazing tool in the toolbox when it comes to real estate. You can buy and hold yourself. You can partner with people. You can actually co-GP on deals. You can syndicate deals. What is it that you're trying to accomplish? For me, syndication is a great way to start another business. We call it multifaceted multifamily, right? We have a property management company. We have an education company. We have a syndication company, right? And we have what we call the 100-year real estate investor. It's a brand that we're selling whole life insurance as well. They're all interconnected to real estate and to multifamily, and that's the power. So for me, I look at syndication when I want to, go and look at a $30 million deal. We just bid on a $30 million deal the day before. I could use syndication because I need to raise 10 or $11 million. That's a great tool to do that. But we just bought 6 units. We're under contract for 6 units. And for me, those 6 units, I'm going to buy them. I'm going to put them in a deal. I'm going to refi and roll them. I'm going to keep them. They're going to pay me forever. So for me, look at syndication as one tool, and it's an amazing tool. And what are you going to do with it? Are you going to use it as a way to start scaling on what we call putting deals on the conveyor belt? Just imagine a conveyor belt that you have out there. Start stacking deals in that conveyor belt. Year 1, year 2, year 3. In multifamily, it takes a good 18 to 24 months for a deal to come to fruition, whether you're trying to reposition it, whether you're trying to flip it out, whether you're trying to refinance the deal. It takes a little time. The more deals you can get on that conveyor belt, the quicker you are to getting wealthy. Does that make sense, Stefan?
Yeah, it does. That's great, Gino. Actually, if you can tell us a little bit, so besides actually doing syndication, which you're making a great point as for, it kind of gives you an opportunity to actually have a business, right? And sort of a multiple different kinds even, and be involved in the community, etc. But even before this, how did you decide to jump into commercial deals for your own deals? What drove that?
For me, you mean
the kind of able to affect valuation, or what was your
you mean for me when I was at the restaurant? You mean when I was working at the restaurant?
Well, yeah. When you started buying your own
Gotcha.
commercial multifamily deals.
So my parents, both immigrants, they were buying little single family homes. They were buying duplexes up in New York at the time when 30 years ago when things made sense up there. And I saw the power of real estate. My mom owned the real estate building, and she had 3 apartments upstairs. And in New York, what happens in New York in January and February? You get snow. Well, when it snows in the restaurant business, you don't get paid. But guess who gets paid? The landlord gets paid. So it was always drilled into me that, I'm working all week. I don't get a paycheck. I don't get paid. But you know what? Mom is getting the rent. So for me, I saw that. And the other thing that I noticed was I didn't want a job. I didn't want to go start fixing and flipping homes. That's just not what I wanted to do. I wanted to get something where I wanted to become an entrepreneur. And, Jake and Gino, we say, we create multifamily entrepreneurs. You have to look at multifamily as a business, as systems, as scalability. I didn't want to start buying one home here, one home there, one home there. Like I said, our first deal was 25 units. And for me, that was huge, but it was easy because Jake was a pharmaceutical rep driving around, doing his sales job. He was in Knoxville in the market, and I was up in New York helping him manage because he didn't know what he was doing. So we were working together as a team. So for me, it made total sense. We actually, on our first deal, we had seller financing on that first deal. So it was 10% seller financing, 10% down, 80% bank loan. And ironically enough, we just wrote a book with our coach called Creative Cash. And I think seller financing and master lease options are going to make their way back in this next market cycle, because I see debt as having a problem. I see a lot of deals right now where you have stabilized deals and people are using bridge debt on stabilized deals. I've never even seen that or heard that, but that's how things are so overvalued right now. And for me, I think once we start seeing that, there's a lot of risk in the market. And the only thing that's helped the market, especially if you're in a good area like Tennessee or Florida, rents have they've gone crazy. No one could have predicted rent growth. What is rent growth? Like 15% this year in Tennessee. It's ridiculous what's going on. That's the only thing that's saved a lot of these syndicators who are buying these deals in bridge debt. My only fear is if interest rates have to go up because of inflation. If sooner or later they have to figure out that we got to raise rates and you have bridge debt, that may be a little bit of risk there. So I think owner financing and master lease options are going to be very, very prevalent in the next couple of years.
That's Bill Ham, right?
Yes.
We had him actually on this webinar.
Yes.
A little while ago.
Yep.
So what are you're saying? What are your thoughts, sort of forecast or personal intuition about the, future of real estate prices, I guess, etc. And you mentioned obviously things being, maybe a bit saturated, etc.
Mm-hmm. It's it's such a hard question to ask, because if you go back and you study history, go back to when, the pandemic hit. We thought in March of 2020 the world was going to end, and then the government decided to give away a lot of free money, and then everything changed. And they're doing the same thing now. And the eviction moratorium is extended in certain states. In Tennessee, it's unconstitutional. So in Tennessee, the CDC's law doesn't hold water. So if you can figure out where people are moving, if you can figure out what's going to happen with interest rates. I mean, interest rates, they're so damn low right now. That's the thing. If you can, we're hedging ourselves and trying to, get long-term fixed rate financing. That's what we're trying to do. And that's why asset prices are really high, because when rates are 2.5% to 3%, money is really cheap, and people know that, and they're willing to take a risk. And I think there's so much private equity money, and I think people are willing to take a hedge against inflation, that they know their dollars are not worth anything. So they're willing to borrow money, and they're willing to really, I don't want to say overpay, but they are overpaying right now for these assets, because when you're looking at it from a cap rate perspective, or from a rate of return, I mean, there's no rate of return today. You're projecting a return down in the future, which is what we want to do. I mean, IRR is great, but what do you know what you're going to sell a property 3 or 4 years from now? You don't even know. You don't know what's going to happen with the climate of the economy right now. So my thing, multifamily is here to stay, because we're being a renter nation. I mean, if you look at the demographics, the baby boomers, there's 10,000 people turning 65 every day. I mean, half the population is either baby boomer or millennial. Less are buying homes, but even though first time home buyers, it was like, 20% last year. It was huge, but there's not enough supply of homes being built right now. That's the other problem. So people are having to rent. And that's why you're seeing this huge uptick in rent. So for me, I still see prices being a little crazy for the next 6 to 12 months. I really do. And but then you take in stuff into the consideration, are we going to have a major recession? That's the thing. Is there going to become a major recession? Because everything's upside down. I've never remembered a recession ending where you have so much demand, but you don't have enough supply. It's the weirdest thing in the world. I mean, you want to buy stuff, you want to go on vacation, but nobody works and there's nothing to buy. It's never happened before. So I don't know what to tell you as far as that goes. I'm still trying to work that out, but we're bullish long term. We're not going to overpay. And I think what we teach at Jake and Gino, we teach the buy right, manage right, finance right. And what we want to talk about is really the buy right criteria. Like, what is your criteria when you're buying an asset? Everyone on the call should think about when they're buying a deal, the criteria. What is your cap rate you're looking for? What is your cash on cash return you're looking for? What is the age of the asset? What is the vintage? The number of units? Is it brick? What part of the city is it in? What is the median income around the area? You have to figure out what your criteria is when you're buying these assets, so that when you find an opportunity, you can bid on it. And it's okay if you lose it, because like you said, you just mentioned Bill Ham. When that plane takes off and you buy the deal, it's in the air. You're landing that plane either wheels up or wheels down, as Bill says. So it's very, very important that when you buy a deal, you don't want to buy a bad deal. And I've bought a couple of bad deals before, and you don't want to do that.
So what are your criteria then, Jim?
So for us,
which market?
Yeah. So for us, the 3 pillars of real estate, it's market cycle, debt, and exit strategy. So let's put all 3 of those together, because when you're looking at a deal, we made this mistake in the very beginning. We never thought of our exit strategy, and that affects a lot. I mean, when you buy a deal, are you going to hold it for the long term? Are you going to flip out in 3 years? Right? Are you going to refi the deal? I mean, that means a lot. If you're looking, for instance, in a small market, and you're going to buy a deal and you're going to flip it out in 2 years, is there demand in that market to buy it, for instance? So make sure you know what your exit strategy is. The next thing is, what part of the market cycle are we in? Right now, we're in the part of the market cycle where cap rates are really low. So you have to be careful when you're buying an older property. There's nothing wrong with C properties built in the 60s and 70s at the right price. The problem now is you're buying these things at 3 and 4 caps, and what we call the capex tsunami. There is a lot of problems going on with these properties. These buildings are old, they're tired. Roofs, driveways, you have plumbing issues from the 60s and 70s. These things have to get taken care of. And if you're overpaying on a property, and then all of a sudden you have that budget and that capital call, that's where a lot of investors are getting really in trouble. So we're deferring in this part of the market cycle to buy assets that are a little bit newer, 80s and newer. We're looking for assets that, pitch roofs. We're looking for assets that are brick. We'd love to buy assets that are 100 units plus, but it seems like those assets, they're very hard to find right now, because they're getting bid up by private equity. That's just going on. So that we're looking at that in our market. Unfortunately, they're 5 caps, between 4 and 5 caps right now. But we need to have a value add component, whether it's valuation through operation, where there's an operation play where there's problems with the property management, where there's high expenses, or you're dealing with the ability to raise rents. That's what we're looking for. And median income, we'd love to see at least median income of at least $50,000. We're looking at a property right now, crime in the area. We had a property that we sold about a year and a half ago. We made the mistake of falling in love with the deal. It was nice. It was 240 units, brick townhomes. But when you look back at it, we sold it. We were fortunate to get out of it. It was not a good area. The median income was, low 30s, and we just should not have bought that property in this part of the cycle. We were lucky, and this is one of the reasons why we're at almost towards the high part of the cycle, is because people are buying deals, and then 18 months later they're flipping them, and then they're flipping them, and there comes a point where someone's going to be left holding that bag. So for us, newer properties, 80s, flat pitch roofs, 5 caps, hopefully, between a 7 and 9% cash on cash return, with interest only on these loans. And then once those loans start amortizing, we can get that 7 to 9% once the loans start amortizing 3 or 4 or 5 years out. And we're looking for, there's 2 types, Stefan. We're looking for either the stabilized one, that's the stabilized 7 to 9%, or we're looking for the second deal type we call is the heavy lift. The property that there is no cap rate. I mean, you walk in and it's just a disaster. There's a lot of rehab. There's a heavy lift. We do one of those a year. And hopefully with those properties, we just did one last year in September. We bought it for 40 a door. We put in 5,000 or 6,000 a unit. Now we're refining it out. It's worth 80 a door. If you can find 1 or 2 of those a year, it's only 48 units. We turned it into a 50-unit deal. We didn't syndicate it. You do one of those deals a year with your team. That's all you need for the next 3 or 4 years, and that will make you wealthy. I mean, we're gonna cost segregate that deal, and we're gonna refi that deal out. So those are the deals we're looking at right now.
That's I think a great example. So you're saying you raised the gross income, you doubled the gross income there.
Yeah, what happened was this was a housing assistance program. It came off a HAP contract, and the rents were like 300, 350, 400, and they came off. It was 50% occupied. We bought it all cash. It was 48 units. What ended up happening was 2 of the units were the office. We were converted 2 of the units to the office. The remainder of the rents went to 725 and 675. So in theory, almost doubled it. Yeah, and the problem is when we bought it, it's in Morristown, Tennessee. We didn't know the market was so hot in Morristown. We did not know that, we knew there was a Chick-fil-A down the street. Jake likes Chick-fil-A. There was a Lowe's down the street. So it was in a good area, but we underestimated the area, how well it was. And, you put these rents on and they're rented day one. It's amazing the demand there. So it's all about that NOI. It's all about increasing that NOI. And that market is actually stable enough where, we can get, a 5.5 to 6 cap on refi.
So Gino, what happened to your valuation? So what was the increase in valuation?
Well, I mean, doubled. Yeah, I mean, it's doubled. And the great thing about it is we bought it with a lot of our employees. Yeah. So what we're doing is we bought it with we bought it with an 80% loan to cost. So 80% loan we actually bought it with cash, and then 30 days later we put an 80% LTC on it. We financed 80% of the rehab. And like I said, last September, we just went to our community bank and we're going to refi it out. And he's valuing it at 80,000 a unit. So we're going to pull all our money out and then some. And it's great because a lot of the team members, especially the younger ones, they love syndication. And like I said, there's nothing wrong with it. But with our business plan, we put in so much work on that asset. And it's basically turned brand new, 20-year flooring, new fixtures. I mean, new everything. I mean, it's basically new countertops, painted cabinets. The asset's got at least 10 years. I would not want to sell that asset and collect all that money, pay capital gains on it, and then go look for another asset. I mean, maybe 3 or 4 years ago in a different part of the cycle, but especially now, this thing's going to be generating $10,000 to $12,000 a month in cash flow, and we have no money in the deal. And it's obviously, like I said, it's got cost segregation benefits to us as well. So that's what our business plan is. That's why for us, that would not have been a syndicated deal. And if it would have been, we would have told our investors, please, can we hold this thing? Can we refi this thing out and we'll pay you your proceeds? The problem is when you refi out, you really have to align yourselves with your syndication partners, because, with the 70-30 split, for instance, we're doing all the work. All of a sudden we refi this deal out. It's 70-30. The LPs get all that refi money back. Us as the GP, we don't really get anything back. So we're adding a tremendous amount of debt on. They're getting all their money back, and then we're going square one. I mean, it's something where I think you would speak to a syndication attorney and say, how do we work it out where we at least share in the profits of the syndication of refinancing that deal out? That's something that we did, and we're selling our first syndication just because of that. We bought it for $5.9 million, and we're selling it right now at 10. So we made a significant amount of money on it. We were going to refi it out, but if we refied it out, they would have gotten the majority of the refi. And
right. So you're making a good point. Yeah, you get paid on your 70-30 split, at the end, and you don't get, access to the refinance part.
Mm-hmm.
Yes. Sponsor. So that's kind of
yes.
That's another consideration. So yes, a question on the chat we have. So did you sell according to your business plan? I think that was for a bit.
So did I sell according to my business plan? We've sold a few smaller assets. So when we're looking to sell an asset, it's basically your return on your equity. We've bought some deals that are really cheap. Some deals that were 25 and 30,000 a unit. Now they're worth 100,000 a door. And is it worth refining those deals? Sometimes it doesn't. You put too much debt on them that you can't make it work. And also they're small. There's no economies of scale there. One of them had PTAC units. So we wanted to actually, hey, listen, we want to, get out of that asset because it's not something that we want to hold in this part of the cycle. So we sell that asset and we repurpose that into another deal. So there are assets that we will sell. It just has to make sense to, why we're selling. We bought a property back in 2018. It was a scattered site, 148 units. It was like 6 or 7 different properties. We've peeled off 2 properties and sold them because they were just older. I mean, in air conditioning units in the wall, to do all the piping and to get it central air is just not what we wanted to do. And that type of tenant is not, they're not as, I would say qualified, but they're just not great tenants to have. So that's an asset that as part of the cycle, you can get an elevated price. So that's the kind of deal that we'll sell in this part of the cycle.
Got it. And what are some markets you really like? So now you mentioned Morristown, Tennessee, kind of surprisingly working really well. Let's say initially was a surprise to you. So what are some, markets you have, done well with or been pretty happy with?
We like Lexington. We have a deal in Lexington. Lexington's a hard market to find deals because there's barriers to entry and it's not a big city. But if you could find a deal in Lexington, I love Lexington. Not a big fan of Louisville. We're selling a deal in Louisville. We like Tennessee. Most of Tennessee is great. I mean, Nashville is a little overpriced, but I mean, everyone's moving there. You always want to look at markets where people are moving, and you really want to look at markets, especially, what you've seen in the last 6 to 12 months, where they're business friendly. I mean, if you can find something in Florida, good luck. I mean, there's so much building going on over here. They never stop. These guys never stop building down here. It's just unbelievable what's going on down here. I would say look at markets that there's job growth, there's population growth.
You guys don't invest in Florida, for example?
No, we're looking within a 3-hour radius of Knoxville. So if you look at Knoxville, we're going within 3 hours. So we love Huntsville. I mean, Huntsville, Alabama is a great market. We're looking at parts of the Carolinas. We like Chattanooga as well. We like the Tri-Cities, Johnson City, within 3 hours because we're vertically integrated. So we have the property management company. So that's what's sort of limiting to us. For me, if I had to buy in Jacksonville right now, I like Jacksonville. I like the Florida market. It's just that we're stretching resources. So we have enough up there. We have enough markets up there that, we stay up there. Everyone's going to tell you Texas, obviously, but it's another expensive market. Everyone's moving to Austin. Austin's been expensive for the last 10 years. So, it's, you're going to get what you pay for, but rents keep going up there. So I've been talking the whole time. Anybody have any questions? Throw any questions in the chat box. I wanted to mention the 3 pillars of real estate. And I thought that was very important because, if you understand what your exit strategy is, and, when you're trying to get out of these deals, you could figure out what kind of debt you're going to put on these deals. I mean, if you're going to flip the deal in 3 years, you're not going with agency financing and getting, yield maintenance or defeasance on it. So be careful, this part of the cycle, what your exit strategy is really, really important. We love using community banks as bridge. They give 5-7 year terms. We use them as bridge. And then when we're ready to refi, we refi out and go to agency. So that's what we like to do.
Can I ask you something? So
Absolutely.
mainly, I like the idea of you control more of the debt, but sometimes it is not always possible when you're scaling up. You have to mix with syndication and all.
Mm-hmm.
But in the meantime, what's your thoughts on focusing on private equity firms or other of hedge funds or who can come up with a big chunk? Did you ever work with such companies, or what's your experience?
Great question. We've never worked with them because we don't need that capital. I've got a community that if I need to, with the Jake and Gino community, I've got over 1,000 people on our investor database that I work with them. I think once you start going to family office money, it's a different kind of thing. You're giving up a lot more control. For us, we're vertically integrated. Remember when I started out, for everyone on here, I want you all to think what you want. We have a property management company. We can only, take down 500, 600, 700 units a year, because once we start taking down assets, we need to keep and employ people. We have employees. So for us to get 2,000, 3,000 units a year, not feasible. That's why syndication, if you're syndicating deals and you're using third-party property management, it's a lot easier to start going into these bigger deals and start buying the deals. So for us, that model doesn't work because we're vertically integrated. But for someone who's out there trying to syndicate deals and they're not doing they're using third-party property management, they can scale up a lot quicker than us. Now, the downside is we're making more money per unit because we're controlling the asset. I mean, we're netting between $150 and $200 per door net after, every month on these assets because we're managing them ourselves, but we have a lot less assets than a lot of other operators out there. For me, the key, and I learned this from my dad, he always said revenue is vanity, profit margin is sanity, and cash is king. I don't care if I've got 6,000 units. If I'm not making any money, it doesn't make any difference to me. I'd rather have 1,000 units or 1,500 units that are making me enough money to me to support myself. So for me, I'm always looking at the bottom line. I'm looking at how well I can structure my portfolio. And then, like I mentioned to you, Stefan, there's so many different ways to generate revenue from multifamily. You have laundry. I mean, you have cable contracts. You have an education, you can write books. I mean, there's so many different ways to actually get money and to create revenue streams from multifamily. It's not just scaling up your operations. So for me, never really looked at that because we haven't done it before. But I mean, there's a lot of people out there that are doing it right now that are bringing in. Jake and I are just equity hounds. We like to own equity in our deals. Transactions pay the bills and equity makes you rich. It's the bottom line. Don't care what anybody else tells you. That's what I learned. And, for me, the last 4 or 5 years, my net worth is, gone up tremendously because I own these assets. They are my assets. I own them and I control them. And one of the reasons why I didn't get into the syndication early on is I've already got bosses. They're called Jake. They're called my employees. Remember, investors are your bosses and you're a fiduciary to them. And that's a different component to the business. Buying deals on your own is one component. But going out and syndicating deals and having investors is another component. That's why it really takes a team to do that. So when you're starting out, just take that into consideration, that if you're starting out and you're syndicating deals, especially in the beginning, it's just another level of complexity. It's not really that much more difficult. Just be ready to, get some team members and have some people help you out with it. I see some other questions on the chat box. Let me see why syndication, not smaller partnerships, or doing deals by yourself? Why syndication, not smaller partnerships? I don't understand that question, Stefan. What do you think that question means? Why syndication?
Yeah.
Yes.
It's I think kind of like what you started with at the beginning, in terms of like some of the business benefits to syndication. I think like the educational side, etc., sort of being more of a broader business or another facet of the business versus your own. It's versus doing your own partnership and own deals.
We started out, I didn't know any better. Like most investors out there, most of us, when we start out, we don't know what syndication is. So me and Jake, we're not the sharpest tools in the shed, as we like to say. We just started buying deals ourselves and they started working. And then all of a sudden we started refinancing these deals. And I'm like, they give me money back because, okay, I'll take that money and buy another deal. And that's the path that led me. Now, this part of the cycle, it may be harder to refi deals, but in this part of the cycle, it's also harder to syndicate deals because to get an 8% or 9% or 10% return is a lot more challenging in this part of the cycle. So syndication in this part of the cycle can be a little bit more challenging as well. I mean, you really have to underwrite for a much longer hold right now. I think it's like a 5-6 year hold that people have to underwrite for now because you just don't know what's going to happen. So just be wary when you start underwriting in this part of the cycle. Come on, we got a lot more questions out there. Hit me.
So just the next question, Gino. So which investor portal software do you use, if any?
We used CrowdStreet in the beginning. They were rather expensive. They charged you per investor. So if you have like 1-2 deals and you have an investor in each of those deals, those are 2 investors. They got to be expensive. It was nice. We ended up going with Groundbreaker. We're using Groundbreaker right now. They're very affordable. We've been using them for the last year and a half. If you're going to do syndication, you need a platform. You need a syndication platform, because you want to be able to have K1s there. You want to be able to showcase your deals there. You want to be able to actually have returns and collect money through the portal. You need to look professional. That's what I said. That's another complexity to it. You need to have this in your business. It's something that you just need it. From our very first syndication, we had a software. One thing that we didn't have when we started out was property management software. We had QuickBooks, and I will tell everybody, when we first started out, they didn't have the solution that they have now. Now there's companies like Doorloop, Buildium, Appfolio if you're much larger. So the biggest mistake we made was not having property management software. We waited to like 600 units to get Appfolio. It was the stupidest thing in the world. We were just being cheap. And when we did it, the skies opened up. It was like, holy crap, this is awesome. But we've just opened a relationship with Jake and Gino with Doorloop. And they're pretty freaking awesome. They've got a really nice API, nice clean platform for property management. Those 2 things, definitely Groundbreaker for customer relations, and we use Doorloop. And also, if you're going to use a CRM, either Pipedrive or somebody like ActiveCampaign they're both excellent. We use both of them. What kinds of returns do you provide to your investors? Well, right now, I mean, it's 8% preferred rate of return on our 2 syndications we have remaining. It's a 70-30 split. We're probably going to end up on this deal with like a 45 or 50 IRR in the deal we're selling right now. So, I mean, it's I don't want to say it's typical, but most of our deals have done that. Our first syndication wasn't. We got a 12% IRR. We held it for 18 months. And, for the second one, it's just, we didn't want to sell it, but it's one of those things, like I said, it doesn't make sense to refi the deal. So we're selling it. I think the investor's going to be thrilled. And, Stefan, I think the next step is, do we start a fund? I don't know if we start a fund or not. I just don't want to collect money, have money sitting in a fund, or have obligations there and then be pressured to go out and to place that capital. That's my fear. It may be a limiting fact. It may be a limiting belief, but that's one of the things we're struggling with right now. So how does your GP equity split amongst the sponsorship team members? So the sponsorship team is, the GP is just me, Jake, my partner, Mike. It's just 3 of us on there. So we're just equal partners. Are you both on the LP and GP side when contributing? You typically have to put money on the LP side. Most banks want to have, the GPs roll money into the LP side and not just AC fees. But if you're looking to get money passively and you have a syndication, I would say absolutely put money on the LP side of your own deal. It'd make your investors feel more comfortable, and you're making money passively. So you're making money through the LP side, you're making money through the GP side, you're making asset management fees, you're making acquisition fees. So that's when it starts making sense. You see how it starts making sense? You got a little snowball going on. So you buy one little syndication, then you have a second one, and you have 2 deals throwing asset management fees, and you've got those acquisition fees. And if you're diligent enough and you're disciplined enough, you're not buying the Ferrari. You're rolling that AC fee into the deal, and you're making $100,000 on this LP and $100,000 on that LP, and all of a sudden you have $300,000 in LP on the LP side at 8%, and you're making $24,000 a year. And it's like, how did that happen? That's what ends up happening if you're diligent and you're disciplined with real estate. What are some of the red flags a limited partner should look out for when vetting a sponsor? Well, we just launched a book. So if anyone wants this book, email me, Gino at jakeandgino.com, and I will send you a PDF copy of the book. It's called Passive Investing Made Simple. Our coaches wrote it. It's a great book, 300 pages. It really goes into, looking at limited partners and what they should look for when looking at a deal. I think when you're an LP, what I want everyone to envision is you're putting your own hard damn money into my deal. You better look at me and make sure that I'm the right person. You better make sure that your core values align with my core values. I'm on here tonight. I'm not feeling great. I love what I'm doing. That's what you want from somebody running a deal. You don't want somebody who's making excuses. You want somebody who's transparent. If something goes bad in the deal, they're going to tell you it's going bad. And they're gonna fess up. And if something goes wrong, they're gonna be there. They're gonna be there with you. You obviously want somebody who has experience, and you want somebody who's done it before. That's what I think you want more than anything else. But as the LP, it's also incumbent upon you to understand the market, to understand how to underwrite a deal, to understand how to underwrite the sponsor, to understand how to, look at the sponsor's team. Do they have a great property management company? Do they have a great syndication attorney? Do they have a great business plan? Do your values and goals align with theirs? Are you looking to put money in this deal and get it back in 2 years? Then you're not Jake and Gino material. I want your money for at least the next 6-7 years. So make sure that your goals align with the goals of the person running this deal. Hey, how do you decide when and add team members when starting a syndication business? Jonathan, that is the $6 million question. That is the bane of every entrepreneur. When do you hire? You know when you hire? When you start thinking about, I think I need somebody. That's when you start hiring. And I got a quick tip for you. I was always afraid of hiring. And let's say you have to hire somebody for $50,000 a year, and you're thinking, where am I going to get 50 grand? I don't know where to get it. Well, break it down into monthly. If it's $50,000 a year and it's 12 months, you basically need $6,000, $7,000 with taxes a month. And if it's a very important hire, they're on a 3-month trial basis. So you're basically committing $21,000 to this person. Do you think you can do that? If you think you can do that, then you go ahead and you commit that money. And after 3 months, if they haven't panned out, you lost 21 grand. No harm, no foul, not the end of the world. For me, my biggest mistake was the I'm a mentality. I'm going to do this and I'm going to do that. And the worst thing that you can do as an entrepreneur, you need that to start out with. But as you start scaling your businesses, there comes a point where you need to let go and you need to say, time out. I can't do everything by myself. I was raised to do that. I'm an immigrant. I worked in the kitchen. I washed dishes. Where did it get me? It got me one restaurant in 20 years. That's what it got me. But as soon as I started hiring and scaling up, and it's not something you're born with. I had to get up. I had to go. We got coached. We got scaling up coaching. We got coaching with with traction. We did a lot of different coaching because we didn't know how to do it. We had no core values. We learned about our cadence of accountability. It was all there. But for the answer to your question is when you're starting to think about it, that's when you need to hire somebody and hire somebody who can help you out with those menial tasks. Jake sucks at bookkeeping. That was the first thing that he hired out, and he sucks at editing podcasts. He edited podcasts for the first 2 years we were doing podcasts. I can't believe that. I mean, what the hell were we thinking the 2 years we was editing podcasts? But I don't know. It just, for some reason, like I said, we're not the sharpest tools in the shed, but we finally said to ourselves, can we hire somebody for $15 an hour to edit a podcast? And we ended up doing it. So for you, once you start thinking about it, man, do it. And there's so many VAs out there. There's so many people out there that you can hire that aren't going to, they're not going to be that expensive for you. Start small. Start with those small tasks that you don't have to do, whether it's writing thank you cards, whether it's underwriting a deal. And it's one thing where I would never give away equity on a deal if you can hire it out. I mean, I wouldn't give equity to somebody if they're going to underwrite a deal for me because you can hire that task out. So make sure that if you're going to hire somebody, you hire them. You don't give them equity in a deal that you can hire for that deal. So do most LPs do their own underwriting? Shouldn't they feel comfortable with a specific deal? Michael, that's a good question. For me, it's 2005. I have the same question. I've got a nice chunk of change. I meet a gentleman named Mike. I'll affectionately refer to Mike to as Maserati Mike. Maserati Mike's got this nice trailer park in Florida. And I am introduced to him by a good friend. And we do the deal. Asked me if I knew what a cap rate was. Asked me if I knew what a cash on cash was. Job growth, population growth. Well, when that deal went south 8 months later, obviously, who did I blame? I blame Maserati Mike, but not really. I should have blamed myself. I should have never done the deal. It was a syndication. Didn't know it was a syndication, but it was. Had a crappy lawyer, had a crappy team members, and I didn't know how to underwrite the deal. If I'd looked at the deal, if I'd gotten my ass on a plane, flown down there, looked at the deal, I wouldn't have done the deal. So for you being an LP out there, it's your hard-earned money. You need to understand the asset. You don't want to just give your money away to somebody and say, hey, I trust you. You really need to learn how to underwrite these deals. And it doesn't take a lot of hard work to do it. Go out there, join a group, and they'll teach you how to underwrite these deals. You're putting $50,000 or $100,000 into a deal. Spend a few $1,000s in your education to learn how to underwrite a deal properly. So when you can vet these sponsors, you can look at a PPM and you can look at underwriting and say, dude, how are you getting 6% job, rent growth for the next 4 years? How's that even happening? How does that? So you can start seeing these things and start calling BS. I wish I'd done that back in 2005, and You know, I always say when a person with money meets a person with experience, the person with experience gets the money, and the person with the money gets the experience. And I got a lot of experience out of that deal, and I never went into another venture without understanding the ramifications of the investment. So I think you have to do your own underwriting as an LP. At least, you know, look at the deal itself that they're presenting to you and poke holes. I mean, you're putting your money into the deal. Don't be afraid, or don't be, what's the word, intimidated that you're asking dumb questions. First of all, they should have a whole PowerPoint presentation webinar to you. They should really go through the whole thing and just get it over to you. But then after that, ask them questions. Ask them about their you know, their, what's it called, when they're making these assumptions. They're making assumptions on a deal. Ask them about rent growth. Ask them about, you know, how are you getting rent growth? Ask them their business plan. You know, it's really important. Like I said, I wish I'd known how to do that back in 2005. I would have smelled that guy out in a heartbeat, but I didn't. I was too busy at work and not paying attention. Does that make sense, Stefan?
Yep. Yeah, it very much does. I think it's like being an LP investor is like incredibly challenging. It seems to me you need to be sort of have a comparable skill to an active investor. You need to really well know real estate and, you know, understand the deals yourself. Otherwise, it's just like shooting in the dark and, you know, relying on others, etc.
Well, what's great about it is it can be passive, because once you find a good operator and the operator is really good and you trust them,
yeah.
You know, what do they say? Bet on the horse, not on the jockey. I don't know what the saying is, but once you find a good operator and you like their model and your values align, man, it's great then. But then obviously they're bringing you deals. Just make sure that, because sometimes operators get shiny object syndrome. All of a sudden they see a shiny object and like, oh, I'm going to go try that. I'm going to go try that. They're in multifamily, now they're in assisted living, but you never did an assisted living deal. How you doing that? Should I go with you on that? I'm not sure. You're in self-storage now, but you were in multifamily 6 months ago. So just be careful with stuff like that. Be careful that they have experience in there, because we're all chasing yield right now. Everyone's going into mobile homes right now. I love mobile homes, but man, sometimes those mobile homes, I don't know, go collect rent. Some of those mobile home parks, I just say, you know what I mean? With those CapEx requirements, they look great. The numbers look great. But at the end of the day, just be careful. Just know the asset. Don't buy just on yield. There's something that we like to call ROE. It's called return on effort. Sometimes you put a lot of effort for a decent amount of yield. And that's what happened with our asset, that 243 units. It was actually weighing down the entire portfolio. We actually sold that asset, and a year later, we were generating more revenue per month with 200 less units in the portfolio than when we had that deal. That's how much work and how much bandwidth and how much energy went to doing that. So when you're underwriting a deal, take that into consideration as well. That's why I said it's nicer to have an asset that's a little bit newer, that you don't have to go do every single repair and worry about that CapEx. So sometimes it's nicer to have assets that are a little bit newer. There's less effort. So just take that into consideration as well. Do you think that investors will start to accept lower preferred returns or IRRs at this point in the cycle, given how cap rates are compressing? Mark, I love the question. You know why? Bill Ham was on here and he was talking about market cycles. And what he said, we're thinking about this. He said, maybe markets don't cycle. Maybe people cycle. Maybe people's returns cycle. And what I think he means by that is, 3 or 4 or 5 years ago, IRR was 20%. IRR was 20 every day of the week, people underwriting. Then 20 became 18. Then it became 16. Then it's 14. Now you're seeing 12. And it really comes down to what investors are looking to get. I mean, we have a 0% interest rate environment. So what happens is things are very speculative. People have to chase yield. That's why crypto is going crazy. That's why the single family market is going crazy. So I think right now people have to place capital somewhere. So I think that they're looking more to the future. They're looking more to, hey, I want to put some money somewhere because I'm afraid of this inflation that's going on. If I leave my money in the bank, it's going to be worth nothing. I'm making 0.5%. I'd rather be making 12 IRR at the end of 4 years. So I think investors have accepted lower returns, and I think they're going to continue to accept lower returns if cap rates continue to drop.
But then, Gino, you mentioned yourself that a few of your deals had like a pretty high realized IRR following the initial target IRR. So is that sort of some of the cap rate compression and sort of rent growth mixed with rent growth and basically asset and income side appreciation? Is that what was
I'm
the
sorry.
result of it? Or I mean, I'm just trying to understand, like when you have a multifamily deal and you're saying they're being underwritten on less and less target IRRs, right? Because they're target
Yes.
IRRs. So they would be
Yes.
initially 20% target IRR, then 18, 16, 14, 12.
I think it's a combination of a lot of things. I think the combination is there's less rent growth. I mean, it's always about NOI, about expanding NOI. You know, IRR, what is it? The discount rate that makes the net present value of all future cash flows equal to the whatever discount. I don't like IRR because we're looking to buy something today and we're going to sell it 5 years from now for a certain price. How do we even know that? I mean, like, to me, it's something where everyone's just focused on IRR. I like to focus on the cash flows of the deal. It's difficult right now to focus on cash flow. So we're underwriting deals for ourselves. What we're doing is you always buy in a pro forma, but you got to buy in your pro forma. That's the thing. So it's challenging. And I think, like I said, you know, when you were getting 20 and 25 IRRs, you were able to expand the NOI a lot more. Prices were lower, so you were able to, you know, increase prices, and cap rates were compressing as well, compressing, going down as well. So you're getting both bangs for the buck, right? So now there's not as much NOI expansion because a lot of these assets have already been turned over. A lot of people have already done their value adds, and now you're getting another deal doesn't have as much value add component to it. Does that make sense?
It does. But I mean, I guess my question is more trying to compare it to like the target IRR space where, okay, in target IRR, things have been compressing and as well, or COVID. And of course, yeah, you made a point, it's like IRR is kind of a funky number, etc. But okay, but you know, so that one, but then on the other hand, you realize IRRs have been really high, right? So like people have on certain projects, so people have done really well. They have said we're going to have a target IRR of 15, but then they have done 40, right, or whatever. So there's a lot of that as well. So where do you think that's going to go?
That's a great question. Yeah, I mean, it depends on the asset. You know, we looked at a deal in Knoxville. They bought it 2 years ago at 105 a door, and we were like, 105 a door for an 80 build in Knoxville 2 years ago, a lot of money. Well, they just sold it for 160 a door. I mean, I don't think these guys would have dreamed of selling it for 160 a door. That's a big number. So like I said, that IRR is a lot more than what they thought. I think price is escalating a lot more than what people anticipated, you know. And we had Brian Burke on the podcast about 6 months ago. And I said to him, you know, what do you think is going to go? And he said the same thing I just said. As he said 2 years ago, we all thought we reached the top of the market. And everyone on here was the 2019, 2020. We all thought the top of the market was reached and the price is going to drop. And now we're at the same level right now. Is that going to happen? We're not sure if that's going to happen. That's why, to be diligent, you have to stick to your buy right criteria that I mentioned earlier on. Be diligent to what you're looking for, what kind of asset you're buying, and you know, overpay. What does overpay mean nowadays? That's the trick. That's the tough part that I'm struggling with, because, you know, when I was buying assets that were a lot cheaper, there was still more risk back then. Because remember, you were always looking at risk. 2013, the economy was terrible. I mean, like I said, GDP was 1%. Rents for a one bedroom were $325 in Knoxville. You know what they are now? They're like $750, $800 for one bedroom. So you can see why NOI has just exploded and why valuations have exploded. There's less risk in buying some of these assets now because, you know, there's more demand. So it depends. But I say you have to have a long-term outlook when you're investing in multifamily. That's the hard part about multifamily real estate. You're not going to get rich overnight. You have to take that long-term approach to it. And if you don't, and you make a mistake, you're going to be in big trouble.
You made a great point actually on like, what does overpay mean? Because like you can be paying, sometimes you even need to pay a higher price per door or etc. to actually access a bigger value add component.
Yes.
And that actually happens. And I think like an example of that would be, let's say, you know, to not bigger syndication, the private investors see it at the small units. If you have like small commercial multifamilies, like you mentioned before, like a 6 unit and etc., like a 20 unit, etc. And often you're going to enter at like incredibly low prices per unit. But there's like so many comparables for those assets. They're not priced, you know, they're not priced exclusively by their income, etc. You're gonna get, you know, sort of outstanding cash flow there, and you're not gonna get the value add. So you actually need to pay a higher price per door, right? And I'm just looking at like my own private investment, let's say. So you're gonna have to enter and pay a higher price per door to actually be able to realize the value add component. And that's a little bit counterintuitive. And like, I also kind of don't like it as an investor. I don't want to enter in like, I know I can pay less at the lower unit counts, but I'm not going to realize the value at the same way. So that, this kind of perspective. And so just like, so just saying, so it's tricky indeed when something is overvalued or not. And then where are incomes today, right? If you have incomes today, for example, at they have also grown like, really well, and their prices are grown, etc. But maybe it's perfectly in line, and things aren't overvalued on the market side as well.
Those little deals, though, I mean, I love those little deals. If you can, the problem is you need some type of economies of scale. If you can buy a 20 unit, 30 unit, 15 unit, they're disjointed. And like you said, there's still a little value there because they're more the mom and pops. They sometimes don't know what they have. These bigger assets, they're priced accordingly. There's calls to offer. You have 15 things. People are going hard on day one. There's a tremendous amount of competition right now. So like you said, what is overpaying? I thought 150 a door for that property was overpaying. They're using bridge debt on that deal. We needed to use 85%, LTC on this thing to buy it. It's a stabilized asset. I mean, rents are $1,000. They can go to $1,500, but I'm paying for the value today that I'm going to create. I'm paying part of that value today, that's what's hard about this part of the market cycle, is that that's what I consider overpaying. I'm paying for the work that I'm putting into this thing. You didn't do the work. You just bought it. You're sitting there. You didn't raise the rents, and I'm overpaying for that because I'm going to do all the work, and part of that value is going to you for not doing the work. That's what I mean when I'm overpaying. And you have to do that in this part of the cycle, but you have to be careful. And that the reason why we did on this asset, it's in a great part of the city. It's 80s build, nice scale, 200 units. So it checked all the boxes. It was great. It's an asset that we don't mind holding for 10 to 15 years. Very minimal CapEx. We were going to do some type of stuff on, whether it was clubhouse or, fitness center, dog park, but it wasn't nothing major. So that's why we're willing to quote unquote overpay, because it's something we're willing to hold for the next 10 to 15 years. Any other questions, guys?
Yeah, if you guys, we have a few more minutes before we, I know Gino's been under the weather, so he's been really nice to talk to us today. So if you have maybe a couple of last questions.
I'm looking to see if there's anything else out there. I see Don video's open. So Don, talk to me. I'm going to pick on you.
Wow. Thanks, Gino. Trying to think of a good question for you. No spot.
Well, what do you agree with me? What do you disagree with me? Let's start off with that. Anything that I said that was like, this guy's totally crazy, and anything I said, I 100% agree with the guy.
I don't think you've said anything that I disagree with. No. So like you said, it just comes down to everybody in their specific, where they're at in their life, I guess, and what they're able to do and not do based on the resources and knowledge. I mean, like, I started with buying fourplexes, myself. That was my first investment property, is fourplex. Here I'm at in Idaho, and then I bought a couple more in Arkansas, and now a few years later, I'm doing new development, so
that's awesome.
It all just kind of, each of us are on their own, place in life, and some people start with single family, and some of them just jump right into the syndication,
So let me ask you a question with the development, because we're going to development right now. Did land all of a sudden just get freaking expensive, where it's like you thought you had a deal and now land is like 25 a door, and it's like, okay. And then you put labor and material and it's like, okay, so the market is so efficient that it's almost pricing itself out to where development made sense for a little bit. But now, is that what's going on? Do you see what's happening? By the way, Idaho is a fantastic market, but it's another one of those really low cap rate markets. Everyone's moving to Idaho. Why would you want to live in California if you can live in Idaho, right?
Yeah, exactly. But no, yeah, I agree with you. So the development I'm doing, so I got some development in Arkansas. I'm lucky we got that at just a great price on the land. Then we've got another development that we're doing here in Idaho as well, but it's a much larger scale with the whole development company and team and stuff. But at the same time, like you said, just the land itself, we're kind of out here near like the Teton area. A couple years ago, so my wife's a realtor, so we're involved with everything as well. But out there, that some people were able to buy more or less off market, and I'd considered at the time holding some land. But I was like, well, I don't want to put that much money just to land, just to sit there not producing income. So I passed on it. But these people bought it for like, I don't know, 25,000, and now they're selling it for 250,000, just like 2 years later. So yeah, there's definitely opportunities there to buy land at that time. Now, probably not so much. It doesn't really make so much sense. But like you said, again, same time, who knows? You don't know. 2 years from now, that could double again. It's just so much unknown right now.
And when you develop, are you going to hold these assets, or you're going to flip them?
So the ones in Arkansas we're holding, it's going to be a 5-unit strip mall.
Good.
I'm holding that with just a JV deal with me and a partner.
That's awesome.
Then the ones here in Idaho are actually building to sell, but it's like 700 condos. So
oh right,
big development there.
700 condos. So you're selling 700. So you got to create an HOA for this, or you're just
Yeah, there's gonna be an HOA. But the condos themselves kind of mixed between condos and townhomes, and this should be built and sold to kind of help with the housing demand right now as it is,
Yes.
and provide some lower priced housing options. But we're also around the outskirts of it. We're looking to probably develop some like self-storage and hold onto those as part of it as well.
That's awesome. That is really good. Good luck with that, bro.
Thanks.
That's awesome. You didn't ask me a question. I asked you a question. Sorry about that.
Yeah, no worries.
I have a podcast, so it's my nature is to ask questions. So
yeah. So I guess the question would be, I guess, going back to when you guys started, and I've heard you guys before, of course, on other podcasts and things, so I kind of know your story. But let's say when you and Jake first started, for example, you bought that first, like you talked about that first 25-unit deal. What helped you get over like the fear of just jumping in and doing something you had no idea about what you're doing? Did you feel enough confident because you guys had enough reserves, or because you had enough income to cover it no matter what happened anyway, or was there just
I hated
where you wanted to get started?
The restaurant. I hated my job. So if I lost 60 grand, not a big deal. That's really what it came down to. There's two things. You have fear, you have anger. When you're afraid, you don't really take action.
Yeah.
When you get pissed off, when you get angry, you tend to take action. So I'm like, dude, what's the worst thing that can happen? The deal doesn't work out. I lose 60 grand. I've got 6 kids. So my whole life I've been hearing, you've got to get six marriages, 6 kids going to college. So I only wanted to make a couple grand a month. I wasn't looking to make a ton of money. So for me, I had gotten coached, so I'd gotten mentored. So I understood the process. I'm like, let's start small. So for 25 units, it was a $600,000 deal. It was, if you whack up 10%, 60 grand between the three of us, it's $27,000 each. It wasn't a lot of money, but it was scary because we never did it before. I had never done it with Jake as a partner. I didn't know how he'd turn out. He's an amazing operator, amazing person. So we can get into core values and how his hard work ethic really, blended with mine. But I just didn't like my situation. I looked around. I'm like, I can't be here 52 years old. And, if I had known, COVID was going to hit, it would have been a lot easier. But if I look back at it now, I'd be in New York with a restaurant shut down during COVID. So I knew back then that the mom and pop, that whole industry was going to death. And I said to myself, I read T. Harv Ekker's book back in 2008, Secrets of the Millionaire Mind. And it really resonated with me when he said, your fruits are in your roots. It's like, you're responsible. And I'm like, who is this dick? He doesn't even know me. And then I said, hold on a second. I said, he's right, because I'm blaming everybody. I'm blaming Obama. I'm blaming the economy. I'm blaming the bit. And then all of a sudden I said, hold on a second. I'm here because of me. So what do I need to do? I needed to learn. I needed to learn the skill set. So I was fortunate. It took me a couple of years to learn. Then I met Jake. And then I said to myself, we'll start small. We'll buy one deal. We'll see how it works. And if it doesn't work, we can always sell it. Because it's not a big risk. But for me, it was more than anything else. And then I got coached. I did some life coaching, and that really, for me, when I became a life coach, just cleared everything up for me. Because everyone talks about Simmons Sinek, what is your why? What is your why? But you really need to drill deep down into what your why is. Like, what is your why? Like, don't say, oh, it's my family. I know it's my family. No kidding. I got 6 kids. We homeschool the kids. No, that's not. But for me, more than anything, Don, I didn't want to come home every day tired, pissed off, angry. And I didn't want to see my kids see me that way at work. So I didn't want them growing up thinking that work was horrible. You didn't want to go. And I wanted to build a great business. I wanted to be an entrepreneur. I don't know why. That was just my dream. And I'm like, I'm sitting here in one restaurant and I don't have the skills. How do I learn the skills? So that really, really lit my fire. So my why was, I just wanted to build an amazing business. I wanted to have the ability to start coaching and teaching and writing books and starting podcasts. I didn't know how to do that, but that's what I wanted to do. And the only way you do that is by getting some type of skill and by buying their first deal. So for me, it's like, okay. And then, the great thing about me is I commit and I figure it out. It's the way it is. I'll send the email and the email is wrong. Then I'll figure it out and I'll send the next email. So for us, that first deal, it was hard. It was a weekly rental. Same way everyone's ever bought a weekly rental here. What a nightmare those things are. We had to re-tenant the whole place. We got it for a good price, but that was a big project. But for me, to answer your question, it was a long answer. I was just clear about what I wanted. I wanted my kids to see that dad really liked what he was doing. I was going to work for a few years. My father had passed away at the restaurant, and I'd worked with him since I was 8 years old. Was I working because of him there? And I just I want to do my own thing. And that's what really drove me. So thanks, Don. That was a good question.
Great. Oh, thank you.
Stefan, anything else?
No, that was really great, Gino. So I know you guys have a multi-family conference, I believe, coming up, right?
Yes.
If you mention about that, as well as how can people reach to you? You've given some great value to
Oh yeah. So October 23rd and 24th, we are having MM4. I think we've got almost 600 tickets sold right now. So we've got maybe 50 or 60 left to go. It's in Orlando. It's at the Gaylord Palms. And we had one back in 2019. It was MM3. We had about 500 people there. So it's a nice event. We're going to have, it's going to be awesome. Florida in the end of October is freaking amazing. It's the financial vacation for smart people. Take your kids down, come to the conference on Saturday, Sunday, go to Disney Friday, Monday, Tuesday. It's going to be awesome. It's going to be a lot of fun. We have all different vendors there. We've got Jesse Itzler speaking. We've got Luke Wren speaking. So we've got some great speakers, and it's going to be all in-house. It's going to be most of our team teaching. We're going to be teaching our buy right, manage right, finance right. So if you want information, just email me, Gino@jakeandgino.com, and I'll send you info on how to get some tickets.
So this was really great. Thank you, Gino. Thanks so much.
Guys, thank you. Nelson, I see you there, Nelson. How you doing, brother? Am I going to get him unmuted or what? Unmute for me. I got to say hello to Nelson real quick.
No worries.
Hey there. Okay, I'm trying to work my finger on him over here.
How you doing?
I am doing great. And now that I'm here with you guys, I'm doing 10 times better.
That's right. That's right. So everything's okay. I saw Nelson about 3 weeks ago. He was in St. Augustine, Florida, and I am a big proponent of coaching and training. And we were actually training with a firearm specialist. I am not a good shot, not good with a firearm, but my son is 18 years old and he loves guns. And if you're going to be a responsible parent, you better teach your kid the right way. So Nelson was up here with us shooting, and he's a marksman, to say the least. It was a lot of fun.
Yes, it was
a great weekend. And glad to see you here this evening. So thanks.
No, and it just for everyone know, there was a lot of leadership by example, because it was a roasting weekend in St. Augustine, and Gino got a bunch of troopers on his team. Now I know what an ice cube feels like on a hot.
It's brutal. It's 95 degrees, and it's great because that's something where you're shooting a gun that takes into consideration. You're getting weary, you're getting tired, so it actually added to it. But it was fun, and it's constant training, and this is what we're doing right now. We're learning, we're training, you're constantly getting educated. So that's what I like about education. That's what I like about Jake and Gino doing podcasts, webinars. You're constantly training and learning and getting better. That's what life's all about. No one's an expert in life. Everyone who thinks they're an expert, they've capped out, they're done. I mean, that's what it is. All the experts, you can't be an expert in life. You got to be a constant lifelong learner. So, it was a lot of fun. So, guys, I appreciate you having me on here tonight. Thank you.
It's really our pleasure. Thanks a lot.
So and actually, I got to apologize. I was running late. I was running over here. Quick question, and Gino, you might have been able to answer this.
Sure.
And I know you spoke about, because I'm going to go listen to the call again. Syndication versus a fund, and it's really a I'm trying to put my thoughts together here. It's really a question on the smaller deals.
Mm-hmm.
Okay, on basically kind of your game plan on going into a market, getting economies of scale and smaller deals. What are your kind of thoughts on that?
So when you go now that when we go into a market, we need to get at least 100 units on that first deal. If we've never been into a market, we'd like to get 100 units. If we're going into Chattanooga, we have no assets. If you're going to syndicate a deal, I would say at least $2 million. If anything smaller than that, it's going to be a little bit more cost prohibitive. Try to partner up with a few people, do a JV, and try to partner up with people. For me, I wouldn't do a fund unless you have a couple of syndications already underneath your belt.
Mhm,
Let's get a couple syndications before you start a fund. You know, we use Kim Taylor. She's amazing. She's an awesome, and she says most people, I mean, like, you know, she's had, you know, Vinny Chopra. He's an amazing syndicator. He's been doing 506Bs, VCs, and he may have started a fund now, but most syndicators out there will do syndications, one-offs, and then all of a sudden they'll start a fund. So I would recommend doing a couple syndications, being completely, you know, comfortable with it. And then all of a sudden, hey, you know what? You've scaled up. The comfort of a fund is that you can go out there, you have dry powder. When you talk to a broker, I've got money, I can close, they take you seriously, and you feel more confident. But you don't need that in your first couple. Focus on just doing one-offs. It's easier for you, especially in the beginning. And that's what I would do, Nelson.
Okay. All right. Well, Gino, I appreciate that. Thank you. Oh,
You're
and by
welcome.
the way, I sent you something in the mail.
You did. Thank you very much. I
Yeah.
forgot that's right. And I responded, and I was at the coaches retreat, and I see the Facebook message, and Bill Ham's like, you're texting him back at like 9 o'clock at night. I said, yeah, I can't let Nelson, because it goes down the thread. I lose the thread with Nelson. So thank you. I appreciate that.
All right. Yep. Thank you, Gino.
Thanks, everybody. Stefan, once again, thanks for having me on. I appreciate it.
Thanks so much. Thanks, everyone.
Take care, everybody.
Thank you.
Stefan, as always, thank you.